Welcome, everybody, to what I call the VA Loan Misunderstandings and Benefits webinar. I'm Cindy Bishop with Cindy Bishop Worldwide. Our distinguished speaker, Mike Ott, brings a wealth of experience to the table with a background as a former public school teacher and an impressive double-digit tenure in the mortgage industry. Mike has earned a stellar reputation. His unique educational approach and unwavering commitment to excellence have endeared him both to clients and agents alike. And if you like somebody that's massively impatient, very, very patient, and very methodical, and doesn't rush anybody, Mike's your guy. He's terrific. Mike's profound understanding of the intricate nuances of the market, coupled with his unparalleled attention to detail, make this market update. Look at me. I've in my brain make this webinar on loan understandings for VA an indispensable resource for agents seeking to stay ahead of the curve. Yes, Mike does teach an awesome market update at every month, which is addition to this. As a senior home loan consultant at First Heritage Mortgage, Mike is well versed in the intricacies of the industry. Additionally, his status as a highly regarded soccer trainer with us further underscores his expertise, since we are super picky about who we allow to teach. Please join us in extending a warm welcome to our presenter today, the one and only Mike Ott.
Thank you, Cindy. Good afternoon, everybody. Thanks for hopping on and hopefully learning some of the little intricacies and maybe having a refresher of sorts with some of the VA loan basics. The goal here today is to kind of understand the basics. If anybody's new or really unfamiliar with the VA loan, I'm going to kind of give you a little nuts and bolts basic understanding of it. And then one of the biggest misconceptions is with the veterans themselves who may have used the VA loan on a previous, home purchase, and they sometimes have that misconception that it's, oh, well, I can only use it once. Where the truth is, you can actually, a veteran, if there's enough entitlement in their calculation, and we're going to look at some of those, so there is some math involved today, or if there's room in their entitlement, there's a calculation that we lenders do, basically say, okay, with your remaining entitlement, you can purchase and use the VA loan again. And that's without, keep in mind, that's without having to pay off or refinance out of or sell the property to pay off the current VA loan. And we're going to look at that from a non-high cost area versus high cost area. And we're going to talk about some of the common credit underwriting nuances and things like that. There's a lot of misinformation out there about how a VA loan's underwritten. I'm going to give you some of the basics there, just some things to keep in mind. And then we're going to look at some common objections about VA loans and kind of how to overcome them. Cindy mentioned that sometimes, listing agents on the seller side, they get kind of freaked out or scared about, entertaining an offer from a buyer that's a veteran trying to use the VA loan. And that's really overdone and exaggerated, in my opinion. There are some things that are definitely stipulations with the VA loan that where there may be some more flexibility with other loan types, and we'll talk about those, but not to the point where I would ever recommend or advise a seller and the seller's agent to not accept or not entertain a VA loan offer. And then there's some really, what I think are kind of some unknown little intricacies of the VA loan from both an underwriting perspective, when you've got a veteran that is trying to make their next loan purchase and have the ability to be non-contingent upon a sale. We're going to talk about how there's some flexibility and wiggle room with veteran borrowers that you really don't get in any other loan type. And then the question I probably get a phone call once a week, especially in our elevated interest rate environment, about how does a VA loan assumption work? Buyers tend to see properties put on the market, and then in the remarks section, the listing agent is saying, hey, we've got an assumable VA loan at 2.5%. Buyers get all excited and they think they can just come right in and just take over the payment, on that loan. And it's not quite that clear cut. I'm going to kind of walk you through that. And it'll be interesting to see if any of you on here been in a transaction where there was the government loan, whether FHA or VA, where an assumption was part of the transaction, because they're not as easy as they might seem. All right, so basics, nuts and bolts. VA, arguably the best loan program out there. It's a zero down payment home loan when the veteran has their full entitlement available to them. The VA does not have a maximum loan amount, right? The VA guidelines, no maximum loan amount. But caveat is a lot of lenders will impose a maximum loan amount. Now, some will go as high as 1.5 to 2 million. And that's pretty much kind of where I see investors and loan servicers that will take on and service these loans kind of tap out. But that's, it's one of those things where we got so caught up into county loan limits for this program and that program, and to not have a maximum loan amount with full entitlement. That's a pretty unique thing. And to be able to go that high is pretty basically shows how flexible the underwriting and parameters can be with this type of loan. Now, a veteran's amount of entitlement will determine the loan limit with no down payment. And that's where the math is going to come in today. We're going to look at some examples. And as Cindy mentioned, when we do the math stuff, just kind of a heads up, I don't want you to feel like, oh, I got to take notes on this, or I got to get these calculations correctly. The calculating really isn't for you. I want you to have the understanding that what's kind of going on behind the curtain when you have a veteran borrower, especially one that's got a current VA loan and they're trying to make their next purchase, and where they're thinking, oh, well, I can't use it again because I've got a loan now. Well, that's not entirely true. There's probably some room in that entitlement calculation. All right, VA. So what the VA does is they actually guarantee the loan. Right? The VA loan guarantee is 25% of the loan amount. Now, as of the first of this year, the high balance limit in the DC metropolitan area is 1,209,750. And the conforming limit on a national level is 806,500. Right. And we've talked about this. We're going to talk about how a veteran borrower can have multiple VA loans at one time. Now, VA's got a very, when it comes to the residence, right? What type of residence? The government loan products, VA, FHA, USDA Rural Housing, are all primary residence owner occupied programs. Now, the VA stipulation is that the veteran or their spouse is to occupy within 60 days of closing. Now, why or their spouse? Because you can have a veteran that's deployed and overseas somewhere, still buying the house as long as the spouse is going to occupy within the 60-day time frame. VA loan offers lower interest rates when compared to conventional loans and no PMI or private mortgage insurance. Now, there is that guarantee, right? When we talk about the concept of mortgage insurance and how are lenders and investors insuring themselves and protecting themselves against loss. In the conventional loan world, we have private mortgage insurance, PMI. And again, all of this is to protect the lender in the event that the borrower goes bad on the loan, right? And we know that the PMI rule is, hey, you're going to pay PMI on a conventional loan in some way, shape, or form if you're putting less than 20% down. FHA's got mandatory monthly mortgage insurance that's on for the life of the loan on a 30-year loan. Or if they're putting 10% down or more, it will drop off in 11 years. but that's a long time. VA doesn't have it tacked in to the payment. It's what they, it's in the form of what they call an upfront funding fee. And VA allows the veteran to finance that if they have to pay the funding fee, and more on the funding fee coming up shortly. And then, you know, one of the things that makes it one of the best loan programs, if not the best out there, is that, especially in an environment like right now, elevated interest rates, veterans are buying homes and rates are, you know, have probably been somewhere between 6.25% and 7.25% for what now feels like 3 years. Well, this is the easiest low documentation streamlined refinance program of any loan product, and that's the VA. We use the acronym EARL, and it's interest rate reduction refinance loan. And what makes it so streamlined is the veteran doesn't have to have an appraisal, and they don't have to jump through all of the income qualifying hoops again. No W-2s, pay stubs, tax returns. They do have to, we do have to confirm that they're still employed. But as far as the income qualifying on that type of refinance, it's the easiest loan to refinance. And that's a huge benefit to the veterans. All right, so every veteran, in order to get the VA loan or be eligible, has to have this VA certificate of eligibility. Now, that's something we, the lenders, we can obtain through the VA portal. A lot of times, the veterans themselves have access to the VA portal, and they can go in and they can pull that for us. If not, lenders do have credential logins to go in and be able to get that information. When they don't come through the automated system like that, we may need the veteran to provide, if they're active duty, a statement of service, or if they're discharged, their discharge documents known as Form DD 214. Now, that funding fee, right? VA has a first time use and then after first use, or what we call subsequent. And the first time use, as you can see there, for if they're doing zero down, right, which is the true awesomeness and benefit of this program, so veteran doesn't have to do a down payment when they, you know, when they've got the entitlement to do so. If they have to pay the funding fee, it's 2.15% of the loan amount, and that gets rolled back in to the financing for total loan. If they do 5% or more down, they slash that fee down to 1.5%. If they do 10% more, they cut it down to 1.25%. Now, any time thereafter would be after first use, subsequent use. The funding fee is much higher. As you can see, it's 3.3% on any subsequent when there's less than 5% down. And then if they get to 5%, it's 1.5%, and then 10%, 1.25%. So it does kind of have that reduction, but that subsequent use fee is arguably pretty high, but the ability of the veteran to be able to just finance that into the loan and not have to have that be part of closing costs due at closing is a huge benefit in and of itself. Now, veterans, when they have a 10% disability rating due to a service-connected disability, 10% or higher, this funding fee is typically waived, which means they're exempt from it.
I have a question.
Yeah,
After 3 years of not owning a home, does it go back to first use? Like for buyers, if they don't have a home for 3 years, they become a first-time buyer. Well, they're eligible for those first-time buyer programs again. Is that the same?
That's a great question. And the answer is no. It's not like being a first-time home buyer and then having a 3-year period when you don't own anything and then being eligible for first-time home buyer programs again. VA, it's once you've used it once, anytime thereafter, forever and ever to infinity, right, is going to be considered subsequent use. Good question. Yeah. All right, so here comes some of the math. And again, don't get too caught up in the math. I'm going to send you these slides. Cindy, you'll have it on my instructor page for replay, but I want to show you a non-high cost area where there's partial entitlement already used. So in this scenario, right, we want to see, hey, non-high cost area with no money down, but I've got a veteran that when I get their certificate of eligibility, it says entitlement used 32,232. All right. Now, that non-high cost loan, maximum loan amounts that 806,500. So how the VA tells us to calculate the entitlement is we take that loan amount for that area, right? Or that county or jurisdiction, we divide it by 4. Now, when we divide that 806,500 by 4, we get 201,625. Now, to find out the remaining entitlement, we take that 201,625 and we subtract from it the currently used amount of 32,232. And now we have a max entitlement amount of $169,393. Now, that's not what they can qualify for, because the next step in doing the math is, all right, well, now we multiply that by 4 again. And that tells us what the maximum purchase price on the next home could be in order to be able to do 0 down payment. So we take the 169,393 times 4 gives us the $677,572, right? So that's the maximum sales price the veteran can purchase in order to do 0 down payment. Now, it doesn't mean they can't buy a home that's priced higher than that 677,572. It's when they go over that, they're going to have to pay 25% of the difference between that 677,572 and whatever the sales price is in the form of down payment. So what does that look like? Well, in this example, we know that the remaining entitlement was the 169,393, and we know that is equivalent to or equals the 677,572 max price with 0 down. Now, let's say they're looking at a house that's priced exactly at the conforming limit 806,500. So how do we calculate what the required down payment is? We have to take that 806,500 minus that maximum calculation of 677,572. So now we get 128,928. That's the number that we take the 25% of, and that whatever that result is, and in this case it's $32,232 for that veteran who's with that prior use entitlement. They can buy that 806,500, but they're going to have to put a minimum of $32,232 down. Now, mathematically, that's kind of equivalent to a 4% down payment based on that sales price. Right. So yeah, one of the things is I think, okay, well, I can only use a VA loan and I can only go up to my max 0 down. No, if they have money to put down, they can go above that maximum calculation. Any questions on that? We'll take a look at a higher, kind of more jumbo price if we will here in a second. That's what's going on in the background. Not that you have to have the math straight in your head, have all this formula. That's the lender's job. But I want to illustrate. But when you got that veteran client who says, I can't, I used my VA years ago, or I got a loan now, they won't let me, now you can't use it again. I'm constantly flabbergasted and surprised by how many veterans believe that it's not a loan that they can use again or have more than one VA loan at a time. All right, so now we're going to high cost area. Now, our scenario with this veteran is they previously used 75,700 of entitlement. Now, the max or the high cost area limit for the DC metro area is 1,209,750. So now we divide that by 4 to get the 302,437, which is, that's how much remaining entitlement. Or that's the max entitlement, sorry, max entitlement. Now, the max entitlement, though, we don't have max entitlement on this particular veteran until we subtract what he's already used, he or she has already used in the 75,700. So once we deduct that, we come away with 226,737, and now we're multiplying that number by 4 again to find that maximum sales price of 906,948. So what that means in this scenario is this veteran who already has a VA loan on another property can go up to 906,948 without having to be required to put a down payment in. Now, what happens, right, if the sales price is much higher? So just like we did before, we're going to keep that 226,737 multiplied by 4 to get that 906,948. Now, to keep numbers super simple on this, we're going to look at a purchase price that's $1,006,948 in sales price, right? And then we deduct that maximum amount, right, to where the down payment cutoff would be, and we're left with $100,000. Now, that doesn't mean they have to put $100,000 down. They have to put then 25% or $25,000 down in down payment. So the formulas are the same. How we're calculating and what we're deducting if they have, the amounts deducted for used entitlement. And then we're looking at that 25% factor if they're going above either the conforming limit or the high cost area limit. All right, that's the bulk of the math portion. So I hope you guys are still tracking. And again, don't sweat it. You'll have the slides. Now, some things about qualifying the veteran, right? When we got active military, right? They get base pay, but they also get and I see that that's misspelled. I got to fix that. Military quarters allowance. That's their housing allowance, and then they have a basic allowance for substance, and then clothing allowance and other allowances. Some have flight pay, hazard pay, combat pay. It depends on which branch of service they're in and what other duties they might have. But we're always looking at that leave and earnings statement from the veteran to see what their base is, BH, BAS, and then if there's any other allowances that they get paid for, and we're using the gross amount. Now, one unique thing about qualifying is the VA doesn't really focus on the debt to income ratio. You might hear lenders say, "Oh, well, they're over 50, so if it's over 50, it can get a little dicey." I've had VA loans go through no problem, be approved, not a blip on the radar throughout underwriting at a 65% debt to income ratio. Now, if your jaw just dropped, right, why would anybody want that much of their income going towards just one monthly housing debt? I would agree with you, but there's always circumstances, right? Maybe the spouse hasn't started a job yet, and we know that they know that their income's going to come. If it goes through the automated underwriting system with a high debt to income ratio, VA doesn't really care about that. What they're looking at is called a residual income requirement. And essentially what we do is we take a look at any income that's left over after all monthly debts plus the new mortgage that they're looking to take on is factored in. And the residual income requirements are based on household size in the region of the country, and they only do, north, south, east, west. And they are surprisingly low income, residual income requirements. So low that when you look at them, you might think, gosh, how could anyone, let alone a veteran, live on that much money and meet all their other obligations, that stuff that's not on the credit report, right? Utilities, food, gas, clothing, clothing, shopping, entertainment, stuff like that. Your normal budgeting stuff. It's not creditor information that shows up on a credit report going into this residual income calculation. So it is really, really flexible. And, you can kind of throw that debt to income that all the other loan programs are so strict about, kind of throw it out the window because the VA cares more about, hey, is there enough money left over after all these obligations for qualifying them, plus the proposed mortgage? Is there enough money left to meet the VA's requirement? And it is a low amount. So veterans typically don't have a problem meeting the residual income, but the DTI, the debt to income ratio on the particular file, per the numbers, could be higher. It's two different ways of looking at the qualification, and VA says residuals. Now, one caveat there. There are some investors that even if it goes through automated underwriting with a super high file debt to income ratio, they may have a cutoff. Some investors don't want a VA loan that's got a debt to income attached to the file that's above 65, regardless of the veteran passing the residual income requirement. Now, VA is probably one of the most flexible in credit underwriting. They actually don't have a minimum credit score. Now, most lenders do. Most lenders will have, usually, I think most lenders are going to be at 600. Some will probably go down to 585, 580 potentially, but most lenders have a self-imposed minimum credit score of 600. And the reason for that, it's pretty much common sense in the track record that, hey, historically, credit scores on government loans like the VA loan that have gone bad typically were loans that were given to borrower profiles with sub 600 scores. Now, lenders don't want, they don't want that negative report card, if you will. Like we don't want to be seen as a lender that's doing these loans that aren't performing. Now, alternative credit's okay. And what that means is, okay, so they don't have credit cards, student loans, car loans, things of that nature on the credit report. What's alternative credit? It might be a utility bill, a cell phone bill, right? We can bill the credit report using those alternative methods. They're very flexible of all the loan programs for bankruptcy and foreclosure. It's a 2-year wait period from the discharge date on a bankruptcy. That's on par with FHA and USD Rural Housing, the other two government programs. They're probably the most flexible, with the foreclosure 2-year time frame, because FHA is 3 years on the foreclosure. So they're pretty flexible on past derogatory credit. Now, when it comes to seller subsidy, one of the coolest things is that by the book, there's kind of a 4%, but really it's more because the seller can pay usual and customary closing costs, including up to 2 discount points. And then they can pay an additional 4%, excluding prepaids, towards whatever, whatever might be in the best interest of the veteran. And when I say that, and I've had a few of these over the years, and it's a beautiful thing for the veteran buyer, is if you as the buyer's agent can negotiate more credit than what is needed, the VA loan is the only loan that allows that excess subsidy that you negotiated out of the from the seller to actually go towards something else for the veteran. Most of the time, what we do when there's excess credit is we'll say, hey, you got, $1,000 extra credit. You get $1,000 less in loan closing costs than we anticipated. This is a use it or lose it type of subsidy from the seller, and the VA will allow you to, send it towards one of your debts, or maybe the $1,000 is enough to pay off a couple of credit cards. Well, the VA underwriting will allow us to do that. No other loan program will allow for excess credit and seller subsidy to be used to, say, pay off the borrower's debts. So it's pretty unique ruling. Now, forever and a day, all right, we were told the veteran can't pay for the termite. Now, regardless, that's changed. It doesn't matter who pays for the termite report, but on a VA purchase loan, know that a termite report is always going to be required. Just within maybe the last year and a half, 2 years, rules have changed where before it was like, oh, the veteran's going to pay for it. So when you do your contract and you're doing the termite inspection, you got to check that the seller pays for it. You want to be more, you want to be more competitive with a VA buyer. Just tell them, hey, pay the $39 to $60 for the termite inspection, and don't ask the seller, because you're allowed, the VA permits you to do it now. The VA does not include the seller paying the buyer's agent's commission as interested party contributions, right? With all the commission stuff that we dealt with last year and kind of, we're dealing with now, and all those new rules, VA came out and said, look, we're not going to include that in the buyer's agent's commission as an interested party contribution if the buyer is paying that to their own buyer's agent. VA now allows the veteran to pay the agent's broker fees. A lot of you work for, brokers where there's a standard pay. There's a standard admin or broker fee of $3.95 forever in the day. You guys as agents probably had to eat that. You're allowed to charge that to the veteran, and it's an allowable fee now. All right. Now, when it comes to objections to VA and sellers not wanting to entertain a VA buyer, right, the number one thing is that complaint is that it takes too long. I'm just curious, when you guys have been on the seller side, do you, or you're representing the veteran buyer, and maybe they didn't, your veteran buyer's contract wasn't picked the winner. What are some of the objections you guys have heard? Feel free to unmute. If anybody's got an experience of having objections to a VA contract or VA buyer offer.
The only thing I've heard is that when the appraisal comes in, the appraiser may find repairs that unfortunately the seller has to fix. And that's all that I've heard, is that if you don't want to fix anything on the home, you do a VA loan, the appraiser comes in and says, yes, this has to be fixed to go through, but the seller did not want to do that. I'm curious to hear what is the objection so that I can counter them with the benefits.
Yeah, no, good. Anybody else? And we're going to talk about appraisal here. A lot of this is about the appraisal for sure. So takes too long, and And sellers agents don't want to deal with appraiser required repairs. And yes, so that can be a concern. Now, keep in mind that the VA appraiser and on any government loan product, they're looking the three S's, right? Safety, structure, and sanitation. So safety, well, we've all probably dealt with or heard of, like a classic one is a stairway that doesn't have a handrail, right? That's a safety issue. Most VA appraisers are going to pick up on that. Windows with broken glass panes, right? Because somebody could be cut. That's a safety thing. Could be easy for somebody to break in, which could be a safety item as well. So they're looking for safety structure. See it quite a bit. Yes, you have to have the termite report to do a VA loan, and that's got to come back clean. But a VA appraiser, unlike a conventional loan appraiser, right, may not be looking so much at structural items. And the VA appraiser might see a wood beam in the basement that's, pitted with termite holes and tunnels and stuff like that. So if your termite inspector missed it, yeah, there's a chance the VA appraiser might pick up on some of that stuff. And yeah, those repairs have to be made and re-inspected prior to the buyer's VA loan approval. And now the only thing, Danetta, is it doesn't necessarily have to be paid for by just the seller. Sometimes agents will chip in, or but your scenario is very true and very real. Now, when you couple that with the thing I like to tell everybody about the VA appraisers is it's in their this next to God is one of the expressions that people use when they talk about the VA appraisers, because they're untouchable in this aspect. And this is where the it takes too long complaint comes in. You have to give them 10 business days or 14 total calendar days from the time the appraisal order is processed to do their visit and get you the report back. I'll be honest with you though, they're not taking that entire 2-week window to do the report. Are there some that have? Are there some appraisers that are in the VA pool of appraisers that sometimes make that a habit more so than others? Yes, but they're the minority in that group. Their VA appraisals coming back just as quick as a conventional loan appraisal, an FHA appraisal. I think that's but I think that's a stigma out there on the seller side is like, oh, it takes too long. And yeah, the risk of the appraiser requiring things to be repaired. Now, there's also the VA mandatory clause, right? And that's what protects the purchaser in terms of appraised value and things of that nature, right? It gives the veteran a legal out if the property doesn't appraise. And that's sometimes hard to overcome, and you'll get objections of that. And what's really tough in our seller's market that we've been in, right, is that if it's a competitive situation, multiple offers, and you've got a conventional offer that's waived all contingencies, I'm not here to blow smoke at you and lie. That's tough to beat. But I do want to kind of put at ease some of these, I don't know, unnecessary fears surrounding going through, going through a VA process when, buying and selling a home. Now, I don't see too many low appraisals, but when the appraiser doesn't see the support in the comparables, they issue what's called a Tidewater notice. And they give us a heads up that it's coming. And then once we get it, that's their timestamp of giving us 48 hours to let all parties in the transaction know. And if the agents want to work together and the veteran borrowers are on board, right? If it came in low, some veteran borrowers are like, hey, then I'm out, right? I'm not paying above and beyond. And if the seller's not willing to come down, well, then we can't come to terms. Sometimes they have money, right? And love the house so much that they don't care. And they're like, I'll pay the difference if it's not astronomical, right? They can do that. But sometimes when it's like, neither side really wants to budge, but the veteran buyer is willing to let the agents look at comparables and provide anything to the appraiser that they think the appraiser might miss for a reconsideration of value, right? But you've got to hustle because you've got a 48-hour deadline to get that CMA with the supporting comps back in front of the appraisal. Okay. So their process of permitting the reconsideration of value is it's flexible in the fact that, hey, if you're going to ask for a reconsideration of value on the buyer side in any type of loan transaction, you're going to have hoops to jump through and you're going to have to put in supporting comps, right? You can do it in 48 hours. The VA appraiser's like, I will consider whatever, I'll take into consideration whatever you send me, right? Now, it's important to know that the veteran buyer has to request this, right, in writing. They have to state, and this writing nowadays can be in an email, that they're on board, right? Because it can't just be the seller side saying, nope, we priced this and the appraiser's wrong, they came in low. We want, this is all about the veteran buyer wanting to explore a reconsideration of value. They have to be on board to do it, not the sellers nor either agent. We need the agent, right? We need you for the sold comparables. And I've seen some where we've done it, turned it around, and it works. The appraiser sees the comparables, takes them into consideration, agrees with the plight, and we see a positive adjustment in value and win-win for everybody. We check that box and move on. We've seen them also not budge on their value. And I will be honest that when they don't budge on their value, it's when the comparables provided by both agents or either agent in the event, they're not comparing apples to apples. So sidebar note recommendation to you on the selling side, right, is, when you're pricing and doing your CMA for your listing presentation, appraisers are not going to lump three-store colonial with a split level, even in the same neighborhood, right? That would be a last resort, apples to oranges comparable for them to use. They're going to find similar build, similar style. And the biggest thing I see is that, 2-level, 3-level colonial versus split level. It's not all about square footage. That square footage is a big part of it, but the style of home too, because that's where I've seen them reject the CMAs that we submit. So, that's good advice when you're on the listing side. When you're doing your pricing to go on the market, make sure you're using comparables that are very similar in the style of the home as well. Comparables should be more recent, similar, greater proximity. No more than 3 total comps is sufficient. If there's more, we'll send them in. And then a concise narrative of why submitting comparables are superior. So with your help on the agent side, we can take a crack at overcoming these, right? If we try and do nothing or the veteran just opts to bail out, then, you know,
Mike, I have a question. Mike,
yeah, hey, Renee.
hi.
Can
I
you-
just wanted to make sure I understood you correctly. Did you say that the buyer has to put in writing that he wants the additional comps?
Yeah, they have to be in support. It's the buyer's request for the reconsideration of value.
Okay,
They have to be on
Thank
board with it. Yeah. So we lean on you as the agent for that narrative and, you know, really sell us on why are these better comparables than, let's say, maybe what the appraiser initially means. All right. This one I love because this is the only loan program that has a super flexible way of having a veteran with a current loan, and doesn't matter the loan type. If they're trying to buy their next home and they have entitlement and they want to do a VA loan, and we're qualifying them for that VA loan, but they don't want to have to sell the house that they're departing first, we can actually present the departing residence as a rental property without having the requirement of the veteran getting an actual lease in place and collecting security deposit and fixing rent. VA underwriting allows us to just mark it as an investment property and then go to Zillow rent estimate, put in the address and use the rent estimate from Zillow. Now, it's not a dollar for dollar, right? But they allow us to do a 75% of that Zillow rent estimate to offset the mortgage payment on that departing residence. So what it's helping to alleviate is the veteran who wants to sell, you know, or plans to sell, it's helping them from a qualification standpoint. It's helping that residual income requirement because we can exclude 75% or we can exclude and potentially offset the entirety of the mortgage payment on the house that they're departing. Without making them get a lease in place. Because their intent all along is to sell in this scenario, right? Now, if they decide not to convert it to a rental, then they could do that too. But most of them want to sell, but we use it, we put it in the loan file. We make the departing residence a rental property. We put in the Zillow rental, and here's a mathematical example here on the bottom half. So the veterans, in this scenario, veterans got a current mortgage payment of $2,550. Okay. Can you guys hear me? Yeah. All right, Cindy, I see I lost all sound on the host end. But you guys can hear me. We'll have to close the meeting. What?
I can hear you.
I am unmuted, but it isn't helping.
I can hear you.
Okay. Cindy, you still not hear me? Wait, I'm getting a text from Cindy. Okay, so if I close it. That's why I asked earlier if you guys could hear me, because I saw a pop-up come up that said I was muted. All right, she's told me to close. Hang tight, guys. Hopefully it's just a matter of me logging back in.